how, if in any way, does it impact your overall view of the equity market?
Well, it was obviously a hot number, and I don't think we're out of the window where we're likely to continue to see that. I think the descriptor being used to describe what we're seeing recently has more often than not been stagflation. I think the big difference between what we're seeing now versus the environment of the 1970s goes to the unemployment component, because the true definition of that 1970s style inflation included a high and deteriorating unemployment rate, and that clearly doesn't fit the bill in this environment. I think really what's happened is we've gone from pro-cyclical inflation in the aftermath of reopening, where demand pushes prices higher, and then you get counter-cyclical inflation when prices get high enough that it starts to crimp economic growth. And I think that's the environment we're in right now. To Steve's point, the pickle for the Fed, of course, and all central banks is they know that tightening policy, either via tapering or rate hikes, doesn't solve the supply bottleneck problem. The rub would be is if they feel that they have to quell demand in order to buy some time or allow the supply bottlenecks to kind of catch up to where demand has been.
Yeah, well, demand continues to be quite strong. But to your point about supply bottlenecks or rising commodity prices or input prices, labor costs, what about margins? We're coming through the latest earnings period. What have you seen, and what are your expectations?
Well, margins have been phenomenal, and you saw actually a pretty parabolic spike in margins in the aftermath of the onset of the pandemic. And I think that reflected the fact that when we were in the worst part of the pandemic, companies basically kind of cut production and slashed everything about their business in order to maintain margins to the best degree that they could in an environment of grave uncertainty. And they haven't quite ramped up, which means the profit margins have remained healthy. But given labor costs are the biggest input cost, and those are now stickier on the high side, I think we're probably looking at third quarter having been peak in profit margins. And that's why I think the commentary from companies with regard to margins and their outlook was arguably more important than the beat rate for the rearview mirror look at the third quarter. So I think margins will increasingly be in focus as we head toward the end of the fourth quarter.